Today I'm going to teach you about Fed funds, the Fed raising interest rates, the 10-year, the 30-year bonds, the inverted yield curve, and how that all affects mortgage rates. So stick around through the video. There's going to be some interesting things that we talk about. Good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is Tuesday, October 17th. I hope you're all enjoying your day, enjoying the beautiful weather here in sunny Las Vegas, which is really nice. We've had a lot of rain this past year, which is odd for us, but it's been cloudy and cold and overcast, which is kind of cool to get a day like this. And it's absolutely gorgeous. And so those of you who don't live out here, this is what October is like in Las Vegas, which is part of what I love about being here. We get into the winter months and we have tons of beautiful days. So as mentioned in the intro, today I'm going to talk about like Fed funds, Fed raising rates, how that impacts mortgage rates and things like that, because there's often a misunderstanding where when the Fed raises rates, it doesn't necessarily impact mortgage rates, especially right away. The Fed essentially controls a lot more than what I'm going to say, but when they're raising rates, they're raising the overnight lending rate that they go direct with banks. So it doesn't really directly impact 10-year and 30-year bonds, but generally as they raise the overnight lending rate, well, that will flow through the system and raise further out rates just because the borrowing short term goes up. Now, the interesting thing is, when COVID came around, they bought a ton of mortgage-backed securities, a ton of longer-term bonds to help support the system so it didn't break. They also brought down the rates super low to help the people be able to refinance and keep the economy moving when they were worried about things really stopping. Now, a lot of people have pointed to this as part of what's going on now and part of the problem. It's related and it's not related, so I wouldn't overthink it. But what they've done is they raised the short-term rates really quickly, which is what everybody's talking about. I'm constantly getting calls. Those of you who don't know, I am a mortgage loan officer, and I'll talk a little about that as well. But when they raised those short-term rates really quickly, while that did help to push the mortgage rates up quickly, it's more important to keep an eye on the longer end of the curve. And right now, when you see the 10-year and the 30-year beginning to raise in yield, which means the prices are going lower, keep in mind what I just said earlier about the Fed buying a bunch of bonds back during COVID. Well, their goal is to unwind that position, which is what I think has been going on. They haven't been raising rates lately. There's a 90% chance that in November they won't again. And you guys can look on CME.com, which is the Chicago Mercantile Exchange, and look at Fed fund rates. You can even Google search the percentage chance that the Fed's going to raise rates at the next meeting or the ones after. And it's really good information as to where the markets think and where they are. There's there's like a 10% chance that they might raise rates, which obviously is a pretty low percentage chance. And I find that they typically go with the traders and they know exactly what's going on. So I don't see them raising next month. Now, the 10-year and the 30-year yield has begun to increase. What I think is going on is the Fed is continuing to unwind that position, which means they're selling the bonds off of their balance sheet. And they have so many that they could just crush the market in either direction. So anytime buyers come in and push the rates the other way, I think they have enough supply that they continue to sell, which is continuing to push the long end to higher interest rates. So there's an understanding when they sell bonds, it pushes the price lower, which pushes yields higher. It's a counter, like they work opposite. As prices go down, yields go up. What I think we're going to see this time, as long as the economy holds up, which it is doing, despite everybody having a tough time, is they'll continue to sell those bonds unless things break or get so bad that they have to reverse and start to undo that. And they'll continue to unwind that balance sheet as long as the markets handle it. It's really amazing how they've been handling it, and I think we might see the yield curve uninvert not where they have to cut the short-term rates to try to save the economy, but where they continue to sell the long end of the curve and it continues to give a higher yield. Even Bill Ackman talked about it, and I feel the same way, which is if I'm going to invest in a 10-year or 30-year bond at this point from the government, I'm not going to do that at 4.5%, 5% return. I would need to get paid better for me to consider buying those longer term bonds. I'm happy to buy a 3-month CD or something like that if I don't know what to do with cash and I want to wait a little bit to see how the economy plays out. But I sure don't want to be tied up for 10 years or 30 years at the same interest rate that I'd get for 3 months. Now, if they start to uninvert where the 10 years paying 6.5%, 7% range, and the 30 years paying 7, 8, 8.5%, I'd be more interested. That'll continue to push mortgage rates higher. And I'm going to try to do picture in picture and show you some shots of where Bank of America is in the mortgage rates. I'm not going to quote my own. It's just what Bank of America was showing. Today, they're showing an 8.375 interest rate, and they're actually charging over 80 basis points to get you to that rate. Now, that's a little less than 1% of your loan amount, and I used a $500,000 purchase price with 20% down, so that's $100,000 down. And any of you can go to Bank of America's website and do the same thing. I find their pricing is usually pretty fair, and most of us are pretty similar to each other. So I find if you go to the big banks and just look at where mortgage rates are, you find a good idea of about where the market is. Now, keep in mind, that's if somebody has credit scores above 740. So you're really looking at best type of paper there is out there to get an 8.375 interest rate with a charge to get there. So rates are right around there. That's a pretty fair estimate of what we're looking at. Now, rates move based on mortgage-backed securities. People keep an eye on the 10-year because they tend to correlate with that and they tend to move in the same direction. It doesn't always happen that way, but it's really easy to find where the 10-year is. There are a lot of sites that'll show it. And to be fair, it really does correlate pretty well with it. So the 10-year is a good thing to keep an eye on. That's why when the Fed raises rates and you see that in the news, that doesn't necessarily mean that mortgage rates go up. On top of that, everybody's well aware, like when we looked at Fed funds rate, what the odds are that the Fed's going to raise rates. The same thing happens with mortgage-backed securities. So by the time the Fed actually does raise rates, typically it's already priced in to where mortgages are, and it doesn't impact it the day that that happens. It's generally moving all along and people making their best guess of where they think rates will be, the mortgage-backed security, not the overnight lending rate. They just all interact together, which is why everybody keeps an eye on it. I do find this time really interesting because normally when the curve uninverts, it's because the Fed ends up having to cut short-term rates. I don't think we're going to see that this time. I think the economy hasn't cracked the way they expected. I don't know if they're going to just push it and push it and push it in the hopes to see it crack. Um, Powell's made some comments about implying that. And those of you who think as a mortgage lender that it's in my best interest for house prices to stay higher and everything else, you guys really have it totally backwards. My best interest would be to see the market crash and it become more affordable and we get super busy again. Right now, with rates being where they are and prices being where they are, the mortgage and real estate industry has slowed down dramatically. I'm sure you hear them talk about it on CNBC and on other channels about how many transactions we're doing versus a year or two ago. Now, it makes no difference to me one way or another. I just give my opinion of where I think the markets are going and what I think is going on. The interesting thing is I really think house prices are going to continue to stay high. I think we may have a period of very little transactions and the market kind of stagnate here, possibly a real long time, until the prices and the interest rate just make more sense and people get more comfortable with it. The same way they're getting more comfortable with groceries where they are and car prices where they are and everything else. That's just my opinion. What I would want, sure, it'd be great if the market collapsed, prices became more affordable, maybe they'd even cut rates, and people who can't afford right now could start affording again. That would get us super busy. Things would be great in our industry. But when I make comments about I don't think prices are coming down, that's just what I think. That's not what I want. I don't benefit by it staying higher. I just think Powell's been clear that rates are going to be higher for longer. And since there are a lot of people, including me, that are kind of pinned into their homes with super low interest rates and really reasonable payments, that it's highly unlikely that they're going to sell and move somewhere else. I'll talk about me specifically. If we were looking to get out of our home, we would have to downsize immensely to get something similar in what we're paying in a monthly payment. We're really fortunate that we love our house and we like where we live, so we're in no hurry to do so. But even if we were, I understand the predicament that people are in because the rates have gone up a good amount from where it was 2, 3, 4 years ago. That if you wanted to move, you're going to be in a position where your monthly payment could go up significantly to buy a much smaller house than the one you're currently in. So I think people aren't real anxious to make that move. On top of that, as rates and costs and labor has gone up, home builders borrow. They don't just put out cash to build homes. And same with most contractors who put up big developments. Well, as rates go up and the cost of labor and everything else, they're in no hurry to just build houses in hopes of getting demand to come in. They've changed their model from 2008, where they wait until they have a contract and a buyer and somebody who's put down payment and earnest money and are getting in the position to buy a property before they start building on it because they don't want to make the payments on the loans, especially at the higher interest rates, unless they feel secure that that property is going to move. Typically, when you see the really good deals from a home builder, that's for standing inventory on a property that somebody had already done that with. The builder collected the earnest money, and I think they're probably using that to do those discounts to get the property sold because that's really their ultimate goal. They're not super concerned about much else. So I hope that was really interesting, and I hope you guys found some value in all of that. I find this stuff super interesting. I know that sometimes people think it's really boring, but I like what I do. I like the markets, and I like keeping an eye on it. So before I forget, do me a favor, thumbs up, like, subscribe. Feel free to make some comments. Feel free to tell me why I'm wrong. Just be respectful and don't think that I say it because of my job. It has nothing to do with that. I just got into the job because this is the stuff I like. So have a great day.